All right, folks. As you know, our topic today is reviewing your portfolio. And we couldn't be more excited to discuss this topic with you. In fact, we've been waiting a long time to bring it to your attention because, frankly, we feel that as a financial advisory firm, if you can't offer something to separate yourself from the pack in terms of how and why you do the things that you do and the value that you can bring to a client, then there really isn't any reason that people should listen or want to work with you. So when I personally hear most of the advertisements on TV, the radio, or online for most of the big financial advisory firms, they all sound the same to me pretty much. So when I see or hear, the first thing that I think to myself is, I guess the only reason why they get so much business is because they're a household name, not because they said something that convinced people that they were different or that they could bring them a value that other firms can't. That's why our goal, that's why our two goals for this webinar today are, first, to educate you guys on the fundamentals of investing and reviewing your portfolio as it relates to reviewing your financial portfolios, and secondly, to discuss some of the most important investing philosophies that we have as a firm that we think separate us from the pack when it comes to this topic and what we do with our clients. But before we do that, I want to thank each of you for joining us today to discuss this extremely important topic. My name is Brian Dougherty of PLC Financial Solutions, and I'm your host along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel.
Hello.
Rachel's our monitor for it, as always, and she will be handling all the comments and questions as we move along, as always. But before we get started, let's take care of some general housekeeping first, as always. First, if the screen is not big enough for you to read, you can actually click on the view options drop down at the top right of your screen to make it larger. Also, you'll see that there are two boxes at the bottom of your screen. One's called chat, and it's for your comments, and the other's called Q&A, and that's for your questions. Please use them accordingly, and Rachel will respond to them in kind. Next, I'm sure that many of you will have questions about the material we will be covering today, but since we have a good bit of it to cover and only an hour to cover it, I'm going to ask you to put your comments and questions in those boxes below, or you can even email them to us at info@plcfs.com. And at the end, we will be staying for some extra time to cover as many of them as we can as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Actually, Rachel will be posting a link for you to schedule that at the end as well. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You will have plenty of time to check it all out again at your convenience. Also, because we want to make sure that you're all paying attention as usual and that you all have some fun as well, before we answer any questions, we have a 6-question quiz, as always, at the end. And the first person who answers each question correctly inside the comment box will win a $10 gift card to a store of your choice. And if you answer multiple questions, you'll get $10 added to each one for each question that you do. So make sure, or that you answer, so make sure you have a notebook handy to jot down some of the brief notes related to some of the bullet points that I point out as we go along, as usual, right, Rachel? Yep. Finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management. an SEC registered investment advisor. And we only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SE registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. So now that we got through that, I have one for you as usual. They're starting to repeat themselves. I do have to admit that. What kind of exercises do lazy people do? Diddly squats. I just like the ring of that one. I don't know. I know I'm going to keep the day job as always. Put it in the comment box if I should keep the day job. Good. Oh no, it's going off. Tons of comments. All right, let's get started. All right, so let's get started with some basics. So, how do you define what a personal portfolio is? This is pretty easy. It's quite simple. It's quite simply the collection of whatever your financial assets are at any given time, such as stocks, bonds, cash equivalents, or even alternative investments like Bitcoin. If you call that an investment, I don't know. I'm not a huge Bitcoin person. Only a little bit. Stage traded funds, real estate, gold, etc. You name it. If you've invested in it, it's part of your portfolio. However, today we're going to be discussing mainly the traditional investments in a financial portfolio like stocks, bonds, mutual funds, and ETFs, exchange traded funds. I said that out of line, which stands for exchange traded fund, and cash equivalents mainly. So when it comes to these types of investments, you generally want a mix of all the different types within your financial portfolio to balance the growth and the risk. How you do this is by creating a balance of the certain types of investments in different proportions. These different types of investments are referred to as asset classes. And they generally come in four main classifications. Bullet point, get those notebooks out. I see you writing now, Bob. First is equities, is the first asset class. Second is called fixed income, or also bonds, which is most commonly attained through owning both government and corporate bonds of all the types. And then there's cash and cash equivalents, and then real estate and commodities. So when you balance these different asset classifications in different proportions, it's called asset allocation. This is what creates a risk-reward profile for your portfolio, which is determined by the risk tolerance that either of you or your situation bears. What happened there? Did I jump ahead? I think I did. I jumped ahead, Rachel. Now I'm lost. All right. We're back on track. As we go along today, we'll break down the building blocks related to these things in order for you to wrap your head around each of these concepts. So, why do I even need a financial portfolio anyway? This is actually a really good question, which I get from time to time, actually. And the simple answer is that a well-invested financial portfolio can help grow capital for future use in a somewhat predictable way. Of course, there are no guarantees when it comes to investing. However, the long history of financial markets can be very helpful at providing insight as to how markets have performed over the long run, and thus can give you the perspective you need to feel more comfortable about investing long-term into a financial portfolio. So even though there's always risk involved when it comes to investing, since the goal is to fund the future of yourself and possibly even your children to a certain degree for generations to come, creating a financial portfolio for the long run is probably the safest and most predictable way to achieve these things. Plus, since we all would like to or may have to retire someday, having a financial portfolio and plan to do so has historically proven to be the most prudent approach to reaching that outcome. So both creating and understanding your financial portfolio is paramount when it comes to meeting your financial goals. Okay, now that you know the basic makeup of most financial portfolios, let's talk a little bit about diversification. Having a diversified portfolio allows you to spread capital across more than just one investment category. Bullet point, get those notebooks out. Diversification. Remember that word, diversification. Into multiple asset classes will help to protect capital in the event one or more asset categories does not perform well at any given time. So remember it, quote unquote. Bullet point, diversification. Now, essentially, diversification is a technique used to reduce risk. The goal is to maximize return by investing in different areas that would each react differently to the same market-based event. So diversification is considered by many to be the most important component of reaching long-range financial goals while minimizing risk. There are two main types of risk when investing: non-diversifiable and diversifiable. Let's dig into them as well. So non-diversifiable risk is associated with every company. This type of risk is also known as systemic risk or market risk. Factors include things like inflation rates, recessions, exchange rates, political instability, natural disasters, terroristic attacks, wars, and interest rates. Man, all that sounds pretty familiar these days, doesn't it? Unfortunately. And they're what's called the undiversifiable risk. No matter what you do, you can't diversify enough to get away from those types of risks. That's what that means. But then there is diversible risk. Now, that's also known as unsystemic risk. And that can be reduced through diversification. You can invest in different companies, industries, markets, economies, and even different countries to mitigate your risks. This is what's known as having unsystemic risk, because none of these are dependent on the same systems for their success. Thus, this form of risk can be reduced simply through portfolio diversification. Now, here are a few other types of unsystemic risk that exist. Things like if a company were to incur new competitors, or regulatory changes, or a shift in management, or a product recall. If you diversify, any one of your companies that you're invested in or stocks your whole portfolio won't be as at risk as a result of those things. Now, these things would be specific to a single company or industry and could cause one investment or group of investments to incur losses, but not an entire diversified portfolio, like what would happen if there was a worldwide crisis like our current pandemic caused in March of 2020. That's a non-diversifiable event, which causes all asset classes to lose value at the same time. And we all saw that. On that note, let's discuss market risks a little more as well. Bullet point, write it down. There are four main types of market risks. These are them. Write them down. There's interest rate risk. And that is the risk that an investment's value will change due to a change in the absolute level of interest rates. This type of risk affects the value of bonds more directly than stocks. As interest rates rise, bond prices fall, and vice versa. I think we all know that, rightly, because the Fed's been raising the rates like it's gone through the roof and causing a lot of people's bond values to go down. And it's the worst they've ever been in the history of bonds right now. So this is exactly what's going on, interest rate risk. And then there's monetary risk. Now, monetary policy impacts interest rates through regulatory committee decisions that determine the size and rate of growth of the money supply. So that's also something that the Fed could get involved in, but it's certainly something that our Congress gets involved in. So then there's commodity price risk. Now that impacts raw material inputs such as cotton, corn, wheat, oil, soybeans, copper, aluminum, and steel. This type of risk not only impacts the raw material, but commodity users as well. For example, as the price of steel rises, this increases the cost of automobile production and can negatively impact the producer's profit margins. Now, there's also political and regulatory changes, seasonal variations, weather, technology, and market conditions that can all affect commodity prices. So there's commodity price risk. And then the final one is currency risk or exchange rate risk. This is the price of one currency in relation to another. Assets or business operations across national borders are exposed to currency risk. This type of risk can be reduced by hedging, which offsets currency fluctuations. Now that we've discussed why it's important to diversify, let's take a look at how to diversify through different asset classes. So remember them, though. The four types of market risks are interest rate risk, monetary risk, commodity price risk, and currency or exchange rate risk. Now, asset classes are groups of similar types of investments that have a diversified portfolio that need to have a variety of asset class investments. For example, if you invest in all equity stocks, even among different companies, you are at a higher risk of loss because equity stocks will typically act the same. If one equity stock drops, you can expect others to drop in price as well, leaving you short on investment funds under certain situations, that is. Now, the different class types of equity asset class, the different class types of assets. You got equities, or also known as stocks. By purchasing a stock, you actually own a piece of a company. And then you have fixed income or debt or bonds. So when you buy a bond, you are actually lending money to a company or government for interest. For example, government bonds, other types of bonds, and certificates of deposit, for example, are all fixed income investments and all part of a debt that you are actually lending. And then there's cash and cash equivalents. So the money in your savings account, in your pocket, or hidden under your pillow, this is actually a promissory note from a government that they are holding for you a certain amount of value. They're holding a certain amount of value for you, which used to be gold I'm not exactly sure what it is these days, but as long as we have a strong military, I don't think it matters that much. Then real estate and commodities, like we mentioned. Now, owning something physical like property, natural resources, like natural resource-based commodities, and precious metals like gold, they all fall into the classification of real estate and commodities. Now, at different times in our history, these different asset classes contributed in different ways to an investor's portfolio. Currently, they do not all hold the same value in a portfolio that they once did. But the reason that many investors invest in them anyway is because they are all part of their own separate and independently functioning markets. So when one market is up, another can be down, flat, or up as well, because these markets do not correlate with each other directly most of the time. So now let's look at each of these asset classes individually. Equity assets are commonly referred to as stocks or shares, and like I mentioned, represent a share of ownership in a publicly traded company. Because equity assets are publicly traded and owned, its share price is published daily, providing transparency. Now, the risks or potential drawbacks are prices are subject to large movements in the stock market because investors can experience large gains or losses at any given time, which is referred to as volatility. The higher the volatility of a stock or any asset, the higher its risk. This is why equities are considered the riskiest type of asset class. Now, the benefits of equities are they have produced higher returns than most other asset classes over a long period of time. Typically, 7 years or longer is a reasonable time horizon for them. And many companies may pay dividends to shareholders, which can provide a steady source of income on top of the value of the stock. Now, the longer you stay invested in equities, the less of a risk they are, because once there is a certain amount of gain above the principal investment, the chance of a loss of principal is reduced over time. Okay, now let's talk about fixed income assets, which are more commonly known as bonds. Now, purchasing a bond is a type of loan. You're essentially lending money to an entity so it can raise funds to finance spending. When a government spends more on health, education, infrastructure, etc., than it receives in taxes, it needs to borrow the difference by issuing bonds. These are referred to as government bonds, sovereign bonds, or gilts. So, what are the risks versus benefits here? Well, the risks are the prices of bonds fall as interest rates on new bonds being sold rise, which is exactly what we're going through right now, which causes anyone holding older, lower interest-bearing bonds to lose value on the asset if they desire to sell it before its maturity. They also come with repayment or credit risk, which is the risk of a bondholder, usually a corporation, but could be government, depending on what the government issues the bonds, not being repaid when the bond matures, if the company or government goes bankrupt. Now, what are the benefits? Well, they're generally regarded as a safer investment option as prices historically have moved less sharply than equities until actually recently. But this is really the first time in history that they've seen the losses that they have. They typically provide a high level of income plus medium to long-term capital appreciation with relatively low risk. They can be inflation linked in order to provide investors with some degree of protection against rising inflation, The US government sells what is called TIPS bonds, which stands for Treasury Inflation Protected Securities. They work by increasing the principal of the investment by whatever the CPI inflation rate for the year is. Now, let's talk about cash investments. Cash investments are a range of securities that typically take the form of short-term loans that pay regular interest. Repayment is usually less than 1 year. Generally, cash equivalents are associated with money market investments. Because money market investments have a short maturity period, interest paid is generally lower than bonds. Asset managers hold a variety of money market securities for their diversification benefits. They're made up of various companies, banks, and government borrowers with various maturities up to 12 months. Now, the benefits to cash equivalents are: one, they're shorter term investment where the money is easily accessible and generally very liquid. Two, they offer better returns than the interest paid in a bank account, at times keeping up with inflation, but not always. Three, money market unit trusts are also more flexible than term deposits offered by banks with no fixed waiting period before withdrawing your money. And finally, they're among the lowest risk investments held by unit trust funds other than physical cash, also known as banknotes. The risks are, since they yield such low returns, they can cause an investor to incur an opportunity risk if they are too heavily invested in. And second, they can fall behind inflation and thus cause an investor's portfolio to not keep up with inflation and thus lose value as it relates to the future value of money. Okay, when it comes to the real estate asset class, there can be a few different types of real estate investment approaches that are considered. The first, you can own property directly, either residentially or commercially. In this way, someone can either collect rent and capitalize on capital appreciation, or just flip properties for the capital appreciation. Second, you can invest in property development, thus build new properties for profit as a contractor or appreciation as an owner. Third, you can invest in a real estate investment company, which make profit from investing in companies that do one or both of the above things we just mentioned. When it comes to real estate investment companies, a listed property refers to property companies listed on a stock market. This asset class gives investors exposure to various types of property, including industrial, office, commercial, and residential space. A share in a listed property company is an equity investment subject to the rise and fall of its share price over time, just like any stock. Now, the recommended investment horizon for this type of investment is 5 years or longer. So what is the risk related to them? Well, this asset class is associated with medium to high risk because it's medium to long-term capital and income growth. Also, many of these investments are illiquid due to property itself being an illiquid asset. And the real estate market can be highly volatile due to it being so closely related to the banking and mortgage-based markets, which are highly sensitive to interest rates and mortgage-based investments, like in the 2008 Great Recession, which was caused by those subprime mortgages that were bundled into mortgage-backed securities. But even lately, we're seeing that mortgage rates are going up because of the rates. So that's affecting property prices. They're going down again. Now, what are the benefits? Well, real estate assets provide income in the form of regular shareholder distribution. The distributions are usually more reliable over time based on rental incomes that rise over time. Also, a listed property is considered a separate asset class to other equities because it offers characteristics of both equities and bonds. Also, listed property stocks are less risky than other equities since their distributions are likely to be steadier. Now that you have a better understanding of what your portfolio is made up of and why, let's discuss some of the different asset allocation choices that most investors have and why. Most financial portfolios have asset allocation choices based on each investor's personal risk tolerance. In order to accommodate large numbers of investors, every asset manager provides several investment portfolios that have different blended proportions of the asset classes that, when together, create a specific risk level for the portfolio in advance. So, like you can see on this list, they generally break down like this. They can be 100% fixed income or all bonds. And that's considered to be a highly conservative portfolio. Although lately they've got hit pretty hard by the rise in rates. Then, or it could be an 80% fixed income, 20% equity mix of asset classes, and that's considered to be conservative. Can also be a 60% fixed income, 40% equities, and that can be considered moderate conservative. And then there's 50-50 in fixed income to 50% equities, and that's considered moderate. And then 40% fixed income, 60% equities, which now we're starting to get on the aggressive. That's considered more moderately aggressive. And then 20% fixed incomes, 80% equities, which is considered to be aggressive. And then, of course, a portfolio that's got 100% equities in it is considered to be highly aggressive. There are always some slight variations from these predetermined asset allocations, but these are the most standard combinations that you will see out there today. Also, the individual investments within these asset classes vary tremendously from one portfolio to the next, and from one asset manager to the next as well. However, whichever investments that they use, they will usually fit into either fixed income / bond or the equity / stock asset allocation classes. At least these days they do. Also, there will usually be somewhere around 2% in cash or cash equivalents in order to keep some liquidity to be available for quick access to clients and portfolio periodic expenses. So now that you have a basic understanding of how most portfolios are constructed as it relates to risk, let's take a look at the different types of investment management strategies that are employed in order to pursue investment returns. Okay, here we go. Bullet point, bullet point. Get those notebooks out. All right, the first investment strategy is called passive investing. And that is also known as set it or forget it investment strategy, or the set it and forget it investment strategy. This is basically how most Vanguard portfolios work. They create an index, could be the S&P 500 or the NASDAQ, or ones that are like large cap, they're geared towards certain types of stocks. And then you buy that and it just stays that way. You don't do anything. The second is called active investing. And this is where asset managers make active choices on what to invest in and when. This causes investments in the portfolio to change periodically. It usually does not change asset allocation in the portfolio, though. Trades are usually made within the current asset allocation makeup. So if you have, say, a 50% equity, 50% bond portfolio, and it's an actively managed portfolio, they're still going to stay in those percentages, but they're going to change the different investments in each of them in those classes based on what that asset manager thinks is the best thing to invest in at any given time. The third is called tactical or quantitative asset management. And it's executed through the use of algorithms that are fed market and or economic data / metrics that trigger trades at predetermined thresholds. Now, these portfolios do not have static asset allocation to provide and mitigate to provide risk mitigation. Instead, they provide ranges of asset allocations. So a moderate portfolio, instead of being set at 50% equities and 50% fixed income, it will have a range of between, say, 65% equities and 35% fixed income. And it can go down to as much as maybe 30% equities and 70% of fixed income. And in some cases could go to 0 equities and 100% fixed income, depending on what the algorithms or the market and economic data is like that's being fed into the algorithms. Now, the final one is called protecting investing. And that is where asset managers use various types of call and put options to both protect the principal invested and to generate income / return on the assets invested. Now, this is the type of investing, these last two, the tactical and the quantitative and the protected investing, they're the type that our firm has been leaning on over the last couple of years. And we're going to take a look at that in a little bit why, but we've been really kind of more favorative to those particular methods of investing as of late. So let's try to tie all these things that we discussed into what considerations you should look at most when it comes to reviewing your portfolio and what adjustments you may want to consider moving forward. Here's a breakdown of the things that our firm thinks should be given priority based on today's financial markets and investment strategies that are available today. First, current fixed income market yields and long-term outlook. Now, I didn't put this in a bullet point this time, but I still think that you guys should treat it like a bullet point and write these things down. These are our recommendations here. So first being the current fixed income or bond market yields and long-term outlook. That's a heavy consideration you have to think about. The second is current equity market returns and long-term outlook. Now, I'm going to give you some examples of this in a minute too. The third is your portfolio return needs and goals. So you should have a bigger plan together that is really dependent on certain needs related to return and maybe even goals related to return. Fourth, the potential return of your portfolio's asset allocation makeup. Now, I'm going to talk about that more in a minute, but these days it really has to be thought about because in the past, certain asset allocation makeups like this, namely the number one was the 60% equity, 40% bond makeup, was considered the status quo as far as getting the type of return that most investors needed long-term and through retirement. Now you have to look at that a little closer to see if that could actually produce what you need. Next, the risk reward profile of your portfolio. Now, this is huge. You'll really need to look at that. And I'm going to talk about how you, what you look for in that in a minute. Also, how volatile is your portfolio? This one is huge, huge, how volatile your portfolio is. And the final one is, what is your portfolio's average return versus its compounded return? Now, I'm going to show you this and why it's so important. And I have gone through this in several of our other webinars. It's just that big a deal. So let's first look at the market-based factors for you to consider. Starting with the current fixed income market yields and long-term outlook. Well, over the last 5 years, the average annual yield of a 10-year treasury note, also is a bond. They call them notes when they go from 2 years to 10 years, and they become bonds when they the treasuries or a debt instrument goes beyond 10 years. And they're bills, considered bills if they're treasuries, they're considered treasury bills if their duration is for 2 years or less than 2 years. So the current fixed income market yields, well, over the last 5 years, the average annual yield of 10-year treasury notes was 2.13%. Now, although lately, and as of today, it was actually 4.25, which is unbelievable, mind-boggling compared to what it was for the last decade prior to this year. But when you average it in to the last 5 years, it actually just comes in at 2.13%. That's how bad the years were before. Now, over the last 10 years, the average is 2.03%. Okay, so we're actually seeing a slight trend of it going upward, okay, which is a good thing because for a long period of time, we were seeing it going down. The problem is they're almost level. It's not the trajectory of that bend is really kind of flat. Now, hopefully, long term with these higher yield rates, they'll stay high and it'll start to really show an upward trend. And then over time, it'll bear itself out. Now, after looking at this, it's pretty obvious that bond yields were trending downward until recently. And this low yielding fixed income / bond market environment had really taken a toll on retirees and investors in general over the last 10 years, whose portfolios either were or should have been more on the conservative side of things, and thus lost return as a result of it, or because many of them had take on more risk than most of us would have considered to be optimal for people in retirement. And sometimes they suffered a result of losses as a result of that higher risk. So, although the trend's looking good for upward now, the long-term trend is still kind of flat right now. And you have to look at that when you're choosing how much you're going to put in to that asset class. If it makes sense to do a 30% equity, 70% bond, when it's that flat historically. Now, on the upside of this, though, it does, like I said, look good for fixed income / bond returns. Because they're making a big comeback, and once the low yielding bonds that are part of most people's portfolios right now, and they're inside those mutual funds and inside those exchange traded funds as well that you don't even know or see going on, once they all mature, and they will, then those bond investments should start to see better returns from those more conservative investments in the not too distant future, depending on the type of bond funds or maturities that you're invested in. Now, if you're invested in 30-year bonds that you bought 3, 4, 5 years ago when they were getting like less than 2%, then you're stuck with that for 30 years. But if you're in a bond mutual fund or a bond ETF, they're going to turn those over. They have all different durations in there. Once the majority turn over, then that investment will actually start to see higher yields again. Let's look at the equity markets and where they've been trending. Because these things you have to consider when you're thinking about what asset allocation you got. You're going to go, 60% equities, 40% bonds. Well, let's see how the bonds are doing, and let's see how the equities are doing, to see if I want to put that proportion of my assets in those asset classes. So we just talked about the bonds. Let's talk about the equities. Oh, where's the trend going? Over the last 20 years, the average annual return was 9.07%. Now, when you adjust that for inflation, which was about, in the last 20 years, it was about 2.91 or 2.61%, comes down to about 6.43%. As compared to the last 30-year averages, which was 10.72% before inflation and 8.29% after inflation. Now, again, you can see that the long-term trend for equities is going downward. Now, let's take a look how that plays out. Okay, so now let's look at the potential return over the next 20 years for a $100,000 portfolio that's made up of 30% bonds, 70% equities, which are considered conservative. So equities, if you look at this, how it plays out, $30,000, given that inflation adjusted return turns into $105,000 in 20 years. And bonds, 70,000, 70% would actually have a negative 0.58 return because inflation was 2.56 and the actual return was only 2.03. At the end of the day, that $100,000 turns into $174.5 thousand with a 7.49% total return, but a compounded return of only 2.81% compound interest after inflation, as compared to what it would have been over the past 30 years. If in the same exact portfolio, the end result would have been a 42.6% total return or 4.52% compounded interest after inflation. Now, that is a huge difference when it comes to return. So, folks, you can all see where the trend is going these days when it comes to the market returns that we just talked about. And these things have to be thought about when you're thinking about how much of each asset class are you going to invest in? Now let's look at the factors to consider most when it comes to your portfolio. To start, your portfolio return needs and goals need to be given serious consideration when you or your financial advisor were creating your long-term financial plan. There had to be a determination of what the minimum portfolio return will need to be in order for you to reach your goals. So, if it was determined that 5 or 6% was going to be needed in order to meet your needs long-term, then a portfolio would need to be constructed that has the potential to do that return. Of course, there are no guarantees, but the potential return must be aligned with your needs and your goals. This way, you're at least in the ballpark with your planning This can be calculated in any number of ways. The easiest way would be to use an online financial calculator to assist you with. Now, second factor you need to consider, you need to find out what the potential return is for the asset allocation breakdown that your portfolio is made up of. This will tell you whether it is designed with the intent of helping you to meet your future goals or needs. If it is not, then you should consider reallocating it to be able to potentially meet them. The main issue with fixed or static asset allocations today is that both equities and fixed income investments aren't returning long-term as much as they used to. And this is causing many investors to have to invest more aggressively than their situation can tolerate if there was a major correction. Thus, the potential return of a 60% equity, 40% bond portfolio or less is likely not going to return enough. But if you increase the equity portion, it is likely to cause the portfolio to exceed your situation's risk tolerance level. So let's consider, let's consider and look at the major portfolio factors at this point. Okay, let's discuss portfolio factor numbers 3 and 4 that you should be considering when reviewing your portfolio for possible improvements. In factor 3, an analysis of your portfolio's risk-reward profile is something that you definitely will want to do. As you can see in this slide, portfolio 1 has a 95% historical range of potential return in any 6-month period of between negative 7.84%, and that's the portfolio on the left here. It has a range of return to anywhere between negative 7.84% and plus 12.65%. Now, that means that in any 6-month period, it has the potential gain of 1.6% for every 1% of the portfolio that is at risk. So it has the potential gain to go up 1.6% for every 1% that is at risk. Now, conversely, portfolio 2 has a potential gain of 2.35% for every 1% that is risked. Plus, both of them have the potential average return of between 4 and 5% annually as well. So both of them have basically the same potential of return, but one has a much greater potential for gain than the other for every 1% of the portfolio that's at risk. This is really important, that ratio. You'll want to pay a lot of attention to that. This means that portfolio 2 has a better risk-reward profile than portfolio 1. This is an important consideration for any portfolio that is being reviewed. In my opinion, a good risk-reward profile is for a portfolio to potentially gain anywhere between 1.75% and 2.5% for every 1% of it that's at risk. Now, let's look at factor number 4, which is determining how volatile your portfolio is. Now, these same portfolios serve as very good examples of portfolios that have similar potential average annual returns, but demonstrate much different volatility potential. Again, since portfolio 1 has a wider range of volatility than portfolio 2, it is, of course, the more volatile portfolio and is thus the less desirable of the two when it comes to this consideration as well. So now let us look at our final portfolio factor to consider when reviewing your portfolio for potential improvements. Okay. The fifth and final factor for you to consider when reviewing your portfolio is to determine how its average simple numeric return compares to its compounded dollar return. Now, your first thought probably is, when it comes to this consideration, it might be, I didn't know that my portfolio's average numeric return could be different than its compounded dollar return. But in fact, it actually can be. And you can only really differentiate this by comparing the actual total dollars earned between two different portfolios that have the same average numeric returns. In other words, you got to find two portfolios that are averaging the same amount of return to see if the amount of money they're actually gaining is the same or not. Also, the variable that causes this anomaly to occur is the difference in volatility between two different portfolios. You can see this you can actually see this clearly when you compare the two wavy lines that are representing two different portfolios on the top graph here. The orange wavy line, which represents the more volatile portfolio, has a range of plus 25% gain and negative 15% loss in any given year. And the gray wavy line portfolio has a range of plus 15% gain and negative 5% loss. And even though they both have the same average simple numeric return of 5% annually, the less volatile portfolio produces a 42.5% total return over 8 years, which is actually a 5.3% compounded dollar return annually, versus a 27.4% total return, or actually a 3.4 annual compounded return in the more volatile portfolio. When you look at the total actual dollars returned, folks, that is a difference of almost 2% annually. So this is a very big deal over the long run. Also, the spreadsheet below in green shows the numerical breakdown of how these two portfolios arrive at these different compounded returns. I created this spreadsheet just so we could actually see how this worked in dollars, because I found the graph first years ago. And I have to tell you that I was completely flabbergasted when I realized this several years ago and actually saw it on this spreadsheet. So at the end of the day, when you're reviewing your portfolio, making sure that it has a good risk reward profile that minimizes your portfolio's volatility is of the utmost importance when it comes to maximizing your portfolio's potential over the long run. Okay, now that you have a good idea of why it's so important for your portfolio to have a good risk reward profile with the goal of keeping its bullet point, write this down, volatility. The goal of keeping your volatility under control. You now know why the second bullet point, one of the main reasons why our firm has preferred and gravitated towards both tactical and protected investing approaches. And that's the second bullet point here. Write it down. We've preferred and gravitated towards the tactical and protected investing approaches over the traditional static asset allocation approach that once was really so reliable for many investors. The bottom line is that one of the main priorities when it comes to both tactical and protected managed portfolios is to minimize volatility. I'm going to say it again. Bullet point, to minimize volatility, which in doing so also mitigates the risk of the portfolio drastically as well. They do this by using algorithms that are fed with both economic and market-based data when it comes to the tactical investing, and by the use of various stock option strategies when it comes to the protected investing strategy. Also, these types of investment methodologies have been in use at the institutional level for many years, but they've just become more accessible to the average investor through different third-party money managers over the last decade or so. So to wrap things up, let's take a closer look at how a tactical investment strategy works and what it is capable of when implemented into a portfolio. So the concept for tactical investment is to build portfolios that have ranges of equity exposure at any given time. As you can see in this slide, each risk tolerance based portfolio has a range of equity exposure that is considered acceptable under normal market conditions and for recessionary market conditions as well. This means that each portfolio has a sliding scale of equity exposure that's considered acceptable for each. This does two things. One, it allows the portfolio to participate more in market rallies when the data feeds the algorithm, when the data that's feeding the algorithm is favorable to do so. And two, it allows the portfolio to reduce equity market exposure when the data feeding the algorithm is when the data that's feeding the algorithms is unfavorable to do so. It's through this concept that market volatility is reduced, and that's our goal. Now, our preferred investment strategy when it comes to tactical investing is concerned actually combines both tactical and traditional, or what is referred to as strategic or static investing together. This allows for the best of both worlds because when it comes to portfolios that utilize purely tactical investing, sometimes the market moves so quickly upward that the delayed response from the portfolio can cause it to lose out on too much upside potential. And conversely, when in an exclusively traditional or static portfolio, the market can fall too far down to where the portfolio experiences too much downside potential. And in this case, the tactical part of the portfolio will limit losses due to its shifting from higher risk investments to lower risk investments prior to the bottom falling out. Now, to be clear, our firm does not develop these portfolios or get involved in the creation of the algorithms that trigger the trades with them. We use a company called Redwood. They have the expertise to do this at a high level and have done so for many years now. However, we do make the determination of which risk tolerance based portfolio is right for each client, and we do this through a very thorough analysis and assessment of each client's portfolio and personal situation. So how do these portfolios work out? Well, now let's look at the next preferred investment strategy. The main objective behind each portfolio, oh, what happened here? Missed the slide, sorry. Okay, when it comes to protected investing, so you know, our firm again does not execute this type of investing for our clients. We work with another third-party money manager called Zega Financial who does that for us. They do this type of investing exclusively and have the experience and expertise in this area of investing that is desirable for anyone who wants to do it successfully. However, we, as their financial advisors, do again perform a full analysis of our clients' financial needs and risk tolerance so that we can determine which type of Zega portfolio is most suited for them. We then match them to it as well as execute the orders for that portfolio to be traded and implemented, which is all, of course, instrumental for the success of the overall plan. Now, with that said, since Zega has several portfolio models that utilize several different stock option strategies, we of course can't look at them all today. But in order to give you a basic understanding of what they are like, let's focus on two different examples at this time. This model here that you see in this slide is called the Z-Big IRA model. It's called this because it was created to conform with the rules and regulations of the federal governments that relate to what type of stock options can be utilized in an IRA. Now, Z-Big stands for Zega Buffered Index Growth. This model portfolio was created to use short duration, high yield corporate bond ETFs. So it's based around bonds, corporate bonds, over a 2-year period, short duration, they mature quickly. And that they're used to protect the principal of the portfolio. And then stock options to capture as much as 65% of whatever the S&P 500 does. So pretty much all the money is sitting in real short duration bonds. Only a little bit is used, about 5%, to purchase these stock options. And those stock options, if the market goes up, will capture about 65% of whatever it goes up. But the 95% of the money is sitting in short duration bonds and held safely. So, as you can see, this Zega portfolio model has a strategy in place through the use of the short duration bond ETFs and the stock options to limit the downside of the portfolio while still providing ample opportunity for a decent amount of upside return. Thus, again, staying consistent with the idea of limiting the portfolio's volatility, just like the Redwood portfolios did. Now, this Zega model portfolio is market-based, since it depends on the performance of bond ETFs and what the S&P 500 does in that 2-year time period for it to get its return. However, Zega does have another model portfolio that is considered an alternative investment that I would be remiss not to mention because it does not depend on the bond or stock markets to get its returns. And it has really delivered some pretty good returns since its inception, which makes it a very attractive model portfolio to consider as well, especially at these times when both markets are down. Let's take a look at that before we wrap things up. This Zega model portfolio is called the High Post series of portfolios, and therefore is a conservative, and there is actually a conservative, moderate, and aggressive version of it. Now, High Post stands for High Probability Option Strategy. And this one single graph represents the same concept that goes on in all 3 versions of the portfolio model. The only difference between them all is how often what they do occurs. So let's talk about what they actually do. This portfolio only sells option positions against the principal to generate its return. So it's only selling options to generate return. The money is not actually in any market. It's actually just selling options to take in income. Now, the principal of the investment either sits in cash or short duration treasury bonds, not ETFs, the actual bonds, 2 years or less. So when they mature, you actually get back the total amount of principal, and waits to see if the income from the options that were sold will be fully realized or not. So in this slide, you can see the red and green line that is going up and down like a stock or ETF price that is riding in the market. But in fact, it's actually not in the market. It's just the value of the stock options that were sold going up and down with the market using, and the options can be either purchased against the S&P 500 or the NASDAQ or any of those general. They usually use those two though. Any of them that they're sold against though can be used, but they're the two that are used most. Also, that big purple half Easter egg looking line is connecting the two index prices, giving us the range from top to bottom that the index price needs to stay between, especially the lower, in order for the income that was generated by the sale of the options to be fully realized. Also, since these types of stock options have an expiration date on them, the index/stock option needs to stay within that purple lineup until it expires, which is once a month in the conservative model and more often in the others. So as you can see, this is the high end of the stock option, and this is the low end. This is what we got to worry about. If this is based on the S&P 500, if the S&P 500 price that they bought the stock option against passes this point, then the strategy can actually start to lose money. There's a 95% probability that it stays above that number, that the strike point they call it, and this other strike point. 95%. Now there's a 2.5% it could fall below here, and 2.5% it could be above. If that 2.5% falls here, then money can be lost. They usually have strategies if they see that happening to mitigate those losses, and they usually will. But if it goes above it, it can actually make more money than it would have as well. So that all being said, the major difference between the three different level portfolios is that the high post conservative only sells options once per month, when the high post moderate and aggressive portfolios will sell options multiple times a month. The moderate being on average twice per month, and the aggressive being 3 or more, and thus generating more risk and income/return from these additional sales. Well, folks, that concludes the educational part of our workshop today. But before we jump into our 6-question quiz and our Q&A for it, I want to make a very special offer to everyone who's attending it. I want to offer everyone here on the webinar today a no obligation complimentary professional portfolio review. And I want to take a minute to explain a little about what that entails and what you can get out of it. So this is what it entails. First, there's 2 ways we can actually meet to do it. The first is online using Zoom, which is almost just like what we're doing this webinar, but instead we'll both be able to see and hear each other, and it'll be completely private. The second is we can actually meet in person at our office. People still do that, you know. It happens, although we've only done it about 5 or 6 times since the pandemic ended. Everybody's getting so used to these things. And our office is in Fort Washington, PA, just off the turnpike. Now, The second thing is it is a two-step process. The first part is that we'd meet to gather the information that I'll need to do that review. And the second is we'll meet a second time to go over the results of it. Finally, what you can get out of this is a clear understanding of whether it would be worth it or not for you to integrate one of the low volatility investing strategies that we discussed today, or perhaps even some other recommended adjustments if they can benefit you with your current financial plan. So if you'd like to take us up on this no obligation complimentary professional portfolio review, Rachel will be posting in the comment box a link to a 60-minute meeting for you to do for us to do that, where you can book that on our calendar yourself. All you have to do is click on the link during that over the next while we're doing the 6-question quiz or our Q&A session. We are going to leave this link open for about a half hour after we finish, so you can copy and paste it after if you want to pay more attention to the quiz and the Q&A. And you can do all that at your convenience. Also, if you have any questions that you'd like answered before you book, you can schedule a brief 15-minute Q&A phone call with me to do that as well. She's going to also be putting that link up too. Plus, folks, we will be leaving this Zoom, like I said, open for an extra half hour, maybe sometimes if I forget, an hour, right, where you can go back and copy and paste whatever it is, those links, or even put in more questions, whatever you want to do. All right, that's it, folks. Now let's jump into our 6-question quiz and our Q&A session. Let's do it, Rachel. All right, first question. Name one asset class we discussed. Did we say we're putting this in the comment or the Q&A?
It's in the Q&A.
Okay.
That's fine. Looks like Bob got that one first. Bob and then Angie. You only wanted one, right?
Yep, only one. All right, looks like Bob's on track again.
Mm-hmm.
Also, folks, and I know already what the answer to it is for you, Bob, but anybody who gets a question right, please put the store that you would like your gift card at. Second question, what is the first technique we discussed to reduce portfolio risk? The first technique. Diversification. Good job, Angie. She's jumping on it. She knows Bob. Been up against them before. All right. Third question. Name one form of market risk. Interest rate. Good one, Bob. You got on that quick. Fourth question. Name the one market condition that reduces a portfolio's compounded dollar return. I practically jumped out of my seat. I mentioned it so many times. Ah, good one, Angie. You writing these down, Rach?
I got them.
All right, fifth question. Name one of the 4 types of investment management strategies we discussed. Just name one.
Bob got it.
Patsy actually had it in beforehand, but I think she put that in for the answer to the other one.
Yeah, that was in for an answer for a different one.
All right. Well, actually, both Angie and Bob got it right, but Bob was in first. You got to stay quick on the trigger, Angie. All right. Final question. Name one of the 2 types of investment managing strategies that I mentioned that our firm prefers based on today's market conditions.
I'll take Angie got it. Angie and Bob.
Angie got it. Good job. All right. Good quiz. Basically, Angie and Bob going head to head, but Patsy jumped in there too. Good job, Patsy. All right. Now we got some questions also in the email, but if there's any questions, I think I saw one here.
Yeah, there's one in the Q&A. You want to do that one first?
Yeah.
Yeah, and that came in, it was in regard to, can you see it? It was in regard to when you had the slide up with the risk reward profile, you know, the ones that look like the speed limit sign, you know, that profile where it had the risk reward. That was in regard to that.
The risk reward, that's the one Angie put in this question for?
Right.
Okay. Yeah, Angie, so sometimes advisory, but when you're dealing with active management and whatnot, sometimes advisory fees and expense ratios can be a little higher. There's no doubt about that. In my opinion, and of course, you know, I try to be as unbiased as possible because I get paid from, you know, obviously advisory fees. If the potential return with the advisory fees and the expense ratio already factored in is the same or greater than a non-active portfolio, since volatility is going to, without a doubt, affect a passively managed portfolio much greater. It's my contention that the compounded dollar return, even with the same potential net average return, is going to be greater in the portfolios that aim to lower volatility. And that's a lot of the gist of what I was talking about between the different passive. Now, regular active management, I'm not as on board with. I do see some, you know, really good money managers out there that, I mean, outperform the S&P by 2 or 3 points every year. You will pay more management fees. Maybe at the end of the day, you end up netting out of that another 1.5 after the management fee. But it's probably likely that volatility is going to be the same issue with them as well. If the portfolio, if the investment strategy methodology is not created to minimize volatility, then the likelihood that volatility is going to affect the compounded return is much greater. Now, if the passive return is an average of 2 or more, you know, percent higher than the tactical or the protected, which I've never seen, but if it was that good, like, you know, then maybe in that point you could end up with the less volatile in that situation, with a more volatile portfolio, ending up with a similar compounded return. So it's my contention that the portfolio that has the lower volatility is going to win out in that situation, regardless of the fees and expense ratios, as long as the average return is the same or better in the low volatility portfolio. All right, anything else?
Yeah. Okay. So in the email, so it says, do you think that tactical and protected investing strategies that you discussed are right for everyone, even younger people that are contributing to a 401k plan at work?
That is a tough one because most 401ks aren't going to have access to those type of investment strategies, unfortunately. But I do believe it would be better because lower volatility, in my opinion, is always going to trump higher volatility. And 401ks are basically built of passive investments. But I think it's more important when a person's, coming up on retirement within like 4 or 5 years, or when they're in retirement. So I can live with the idea of the more volatile portfolios up to then, because there's not much you can do about it. But it's still more tolerable, I suppose, when you're younger and you have more time to deal with it. And you're, the fact that you may not, the possibility of having a catastrophic event that could cause you to need a lot of money out of your portfolio is a lot less. That's a possibility because of age. I absolutely think the lower volatility method is better.
Okay, so another one says, with both stock and bond markets down this year for the first time ever, what kinds of investments do you think people should invest in?
Again, I think you have to pay attention to the, like when it comes to bonds and equities, paying more attention to the certain types that you're invested into, or using a different methodology like the tactical or the protected it's my choice. It's not that you're invested in different asset classes, it's your way of investing in them that is important. When it's passive, it's a lot trickier. But when there's a rhyme to reason, you can utilize those asset classes in a different manner, like the tactical and the protected do, and you can achieve better results as a result of it.
Okay. Do you think a portfolio full of high quality dividend paying stocks is the best approach to making good income in retirement?
Well, that is a way to use equities differently. Okay, that I give merit to, no doubt about it. But I'd actually prefer to see that type of portfolio in a protected scenario, because those types of stocks, can be volatile as well, even though the dividends can be real consistent. And I'd like to see them protected against some of that volatility. You can even boost them with some income from options as well. So it's definitely a good alternative to just the regular asset allocation if you're retired and need income. But if it was protected and used options in some ways, I think it could actually be even bolstered better and protected more. Just in case, what if there was an emergency? You're taking that income, but the market goes down real low and you just happen to need a lot of your assets. You got to pull out of there. Now the value's down and you just took a massive loss. But if you had them protected, maybe you wouldn't need to do that. One more, I guess.
One more. Do you prefer stocks, mutual funds, or ETFs?
I mean, again, if it's dividend based, I think that stocks can make a lot of sense. But I always prefer ETFs to mutual funds when it comes to retirees, because they trade like stocks and you can get in and out of them at any time of the day, just in case, like it was in 2000, in 2020, the market started falling quickly. And you had somebody who's living off a large portion of their portfolio, you can just pull them out. Well, you can't do that with a mutual fund. But if someone's working their years from retirement, mutual funds just as well. All right. That we're going to call it a quit on that. Also, here's the references. Rachel's going to put them up, the sources that we used. She's going to put them up. All right, folks, that concludes our workshop for today. I just want to thank everyone who attended for being the type of people that care enough about themselves and their family to spend their precious time learning about this important topic tonight. I truly commend you all for that. Also, I want to remind you that if you have any questions related to this topic we covered today, or our offer for the no obligation professional portfolio review, or if we did not answer your question in the comment box, I know we skipped one, or about anything else for that matter, and you'd like to discuss it with us further, just click on one of the links that Rachel posted and schedule a time at your convenience for us to do so. Well, that's all for today, folks. On behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, say bye, Rachel, and myself, Brian Dougherty of PLC Financial Solutions, located in the Fort Washington, PA area, where you can reach us at either 215-804-9708 or by phone, or at info@plcfs.com, or you can even just go to our website at plcfs.com, where all our information is there at all times. Also, please mark to your calendar for Tuesday, November 29th, 2022 at 7 p.m. For our next webinar. Remember, we do them on the last Tuesday of every month. Have an awesome November and happy Thanksgiving, folks. And we'll see you then. Have a great night and go Phillies. Go Phillies. See the Phillies background here, Rach? I got my Phillies red on for Red October. Have a great one, folks.
I saw you were sitting at Citizens Bank.
Yep, that's our pictures from the last game we went to.
Great.
Have a great night.
Good night, everybody.